Stop right now. Do not sell a single ounce until you understand what just happened. Silver just did something that most people will explain the wrong way. And if you own even a little bit of it, whether it's physical metal in a safe or an ETF in your brokerage account, this matters more than the price itself. In the last 48 hours, we watched silver surge hard, look like it was breaking out, and then snap back with a violence that made your stomach turn. This was not a gentle pullback. This was not a healthy correction. This was a weapon. It was the kind of move designed specifically to make confident people suddenly doubt their entire thesis. It was the kind of move that makes cautious people who finally bought in at the top panic and sell at the bottom. So what exactly happened? Why did the floor drop out just when it looked like we were going to the moon? Here's the truth the media won't tell you. Silver has entered the BASI, high volatility momentum phase. This is the zone where 8% to 10% swings don't happen over a month. They happen over lunch. The market is behaving like it is preparing for a siege on the most important psychological number in financial history, $100. But here's the twist. The same volatility that is required to launch the price through $100 is also the weapon being used to wipe out the late buyers and the over-leveraged traders. We are in the hot zone. There is a target near $106 sitting above us like a magnet, but the path to that magnet is mined. If you don't understand the mechanics behind these smashes, if you don't understand the difference between a trend change and a leverage flush, you're going to get shaken out exactly 24 hours before the move you have been waiting 5 years for. Most people look at a red candle and think selling. I look at a red candle and see liquidation. The smash we just witnessed wasn't because industrial demand collapsed. Samsung didn't stop building electronics. The solar fields didn't stop expanding. The smash happened because the paper market got too heavy. When too many people pile onto one side of the boat using borrowed money, margin, the market makers don't just let them ride to riches. They rock the boat. They rock it until the weak hands fall overboard. That is what we just saw, a mechanical clearing of the deck. And while it feels terrifying, historically, this specific type of volatility is the hallmark of a market that is about to go parabolic. It is the storm before the calm, but only if you survive the storm. So, in this emergency update, I'm going to walk you through the real forces driving this action, specifically the gamma squeeze, mechanic sitting just above 100, and why the miners are lagging in a way that might actually be the biggest bullish signal of all. Let us stare directly at the number that is haunting every trading desk on Wall Street right now, $100. For years, silver has been trapped in a psychological box. But $100 is not just another number. It is not just a resistance line on a chart. $100 is an event horizon. Humans are simple creatures. We operate on round numbers. $99 feels like a commodity price. $100 feels like history. It feels like a paradigm shift. And because everyone, from the retail stacker in his basement to the algorithm at Goldman Sachs, knows this, the approach to $100 creates a very specific, very violent type of turbulence. They tell you that $100 is a ceiling. The reality is, $100 is a fuel tank. To understand why, you have to understand the gamma squeeze. I'm going to simplify this because it is the most critical mechanic in the market right now. When you buy a call option betting that silver will go to $105 or $110, a market maker, a bank, sells you that option. The bank does not want to gamble. They want to remain neutral. So, as the price of silver rises closer and closer to $100, the bank is mathematically forced to buy futures contracts to hedge their risk. This is the gamma kicking in. The closer we get to the strike price, the more physical silver futures the banks have to buy. It creates a feedback loop. Price rises. Banks buy futures. Price rises more. Banks buy more futures. This is the fuel tank sitting just above $100. There are billions of dollars and out of the money. Call options sitting at $105 and $110. If we breach $100 cleanly, that fuel tank ignites. The banks become forced buyers. They stop suppressing the price and start chasing it. This is how you get a melt-up. This is how you get a vertical line on the chart. But the market knows this too. The smart money knows that you know this. This is why the approach to $100 is never a straight line. It is designed to be a meat grinder. Here's the playbook they run at major round numbers. Scenario A, the tease and reject. They let the price run to $99.50. You get excited, you buy the breakout. Then they dump a massive block of sell orders. The price crashes to $92. You panic. You think it failed again. You sell your position at a loss. And the moment you sell, the pressure lifts and they run it right back up. Scenario B, the blow off top. They let it punch through to $100. Everyone screams, breakout. The headlines run the story. The retail crowd floods in. And then they pull the rug. They sell into the liquidity. The price snaps back below $100, trapping all the new buyers underwater. Both scenarios are designed to do one thing: reset the leverage. They need to shake off the passengers before the rocket leaves the atmosphere. If everyone is long, if everyone is loaded up on margin, the rocket is too heavy. It can't fly. So the volatility we are seeing right now, the 8% swings, that is the market lightening the load. This brings us to the second major force driving this chaos, the margin call. Every time silver dumps hard, like the 8% smash we just saw, people scream manipulation. They scream that the Fed is rigging it. They scream that JP Morgan is smashing it. And sure, sometimes markets are unfair, but there is a much cleaner, much more boring explanation for these sharp pullbacks: mechanical deleveraging. Let me explain this with a simple metaphor. Imagine you are at a casino. You are betting on the roulette wheel. The casino, the broker, lets you bet with borrowed money. You put down $10, but they let you bet $100. This is great when you are winning, but suddenly the room gets shaky. The lights flicker. The volatility rises. The casino manager taps you on the shoulder and says, "The game is getting too risky. If you want to keep betting $100, you need to give me another $20 in cash right now." This is a margin hike. When volatility rises, exchanges, like the CME and brokers, increase the margin requirement. They demand more collateral from traders to keep their positions open. Now, imagine you don't have that extra $20 in your pocket. What happens? The casino manager doesn't care about your feelings. He doesn't care that you think the wheel will hit your number next. He forcibly takes your chips off the table. He sells your position to cover the debt. This is exactly what happens in the silver market during a whipsaw. Thousands of traders are leveraged 10x or 20x. When the price drops 2%, they get a margin call. They need to deposit cash. They don't have the cash. So the computer automatically sells their silver position. This selling drives the price down another 2%, which triggers more margin calls for more traders, which causes more automatic selling. It is a cascade. It is a domino effect. The price isn't crashing because the fundamental value of silver changed. The price is crashing because a computer algorithm is liquidating insolvent gamblers. And here's the part most people miss, and why this creates such an incredible opportunity for you. The people who are leveraged in silver are usually leveraged across the entire market. They are long tech stocks. They are long crypto. They are long gold. When they get a margin call, they have to raise cash fast. They don't sell the things they want to sell. They sell the things they can sell. They sell their gold. They sell their silver. They sell their winners to pay for their losers. They tell you the price drop means the asset is bad. The reality is, the price drop means the owner is broke. This is why you see these ugly, terrifying candles that look like the end of the world, followed by a recovery that looks like nothing happened. The move wasn't a new narrative. The move was plumbing. It was a liquidity event, not a value event. This creates a very dangerous trap for the uneducated investor. If you're watching the screen and you see silver tank 5% in 10 minutes, your lizard brain screams, "Something is wrong, get out." But if you understand the margin mechanic, you know that this is just a flush. You know that once the forced sellers are wiped out, the selling pressure will vanish instantly. The beach ball that was being held underwater by the forced selling will pop right back up. This is why being right about the direction is not enough. You can be 100% right that silver is going to $150. But if your position is too big, or if you're using too much leverage, a mechanical margin dump will remove you from the trade at $80, right before it goes to $150. You will be right, and you will be broke. The only way to survive the margin call cascade is to ensure that you are not the one getting the call. You must be the casino, not the gambler. You must hold positions that cannot be liquidated by a computer. This is why physical silver is the ultimate hedge against volatility. No broker can force you to sell the coins in your safe. Now, let's address the elephant in the room. The question that is confusing every logical investor right now: If silver is rocketing towards $100, why are the mining stocks lagging? You look at your screen. Silver is up 3% on the day. But the big miners, Pan American, First Majestic, Hecla, are flat or even red. This divergence makes you feel like the move is fake. It makes you feel like the equity market knows something you don't. But actually, it's the opposite. The equity market is broken, and that is your edge. The input cost trap. Here is why they are lagging. Inflation. When the price of silver goes up, Wall Street algorithms assume that the cost of mining it goes up too. They look at rising oil prices, diesel for the trucks, and rising labor costs, and they punish the miners. They treat miners like industrial companies instead of monetary proxies. But this is lazy analysis. Let's do the real math. If the cost to pull an ounce of silver out of the ground rises from $25 to $30 because of inflation, that's a $5 increase in cost. But if the price of silver rises from $80 to $100, that's a $20 increase in revenue. The profit margin didn't shrink, it exploded. The general market? Drag. The second reason miners are lagging is that they are trapped in the equity bucket. When the S&P 500 wobbles, when the tech stocks sell off, portfolio managers sell everything. They sell the winners to pay for the losers. They dump their mining stocks not because they hate silver, but because they need liquidity. The snapback. This creates a massive valuation gap. The metal is pricing in a new paradigm. The stocks are pricing in a recession. Historically, this tension only resolves one way, the catch-up trade. The miners are a coiled spring. The further they are held down while the metal rises, the more violent the snapback will be. When the generalist funds finally realize that these companies are printing cash flow at 50% margins, they won't just buy, they will panic buy. If you think this volatility is unprecedented, you need to open a history book. We are watching a frame-by-frame replay of January 1980. That was the month the Hunt brothers, two Texas billionaires, tried to corner the silver market. They drove the price from 6 to 50. But here is what people forget about that run. It wasn't a straight line. In the final weeks before the peak, the volatility was absolutely nauseating. Silver would limit up one day and crash 15% the next. Margins were hiked repeatedly. The exchanges changed the rules almost daily. The Rule 7 warning. The climax came when the COMEX invoked Silver Rule 7, a rule that effectively said, you can only sell, you cannot buy. They changed the rules of the casino to bankrupt the players. Why am I telling you this? Because in 2026, the Hunt brothers aren't two guys in cowboy hats. The Hunt brothers of 2026 are the solar industry, the Chinese government, and the AI data centers. In 1980, the squeeze was speculative. The Hunt brothers didn't need the silver, they just wanted the profit. In 2026, the squeeze is existential. Samsung needs the silver, Tesla needs the silver, China needs the silver. You cannot Rule 7 a shortage of physical molecules. You cannot legislate away the need for conductive metal. This means the volatility we are seeing now is actually more dangerous than 1980. The desperate flailing of the paper market, the margin hikes, the smashes, the media hit pieces, it is all an attempt to stop a freight train with a piece of paper. It might slow the train down for a day. It might shake you off the tracks. But it cannot stop the collision. The volatility is not a sign that the top is in. The volatility is a sign that the mechanism is breaking. We have arrived at the conclusion. If you have stayed with me through this deep dive, you now understand the invisible war being fought right now. You understand that the $100 level is not just a price. It is a psychological minefield protected by a gamma squeeze that forces banks to defend it. You understand that the brutal 8% drop we just witnessed was not a change in fundamentals. It was a mechanical margin flush designed to strip the leverage out of the system. And you understand that the minor lag is a temporary distortion caused by inflation algorithms that are about to break. The market is currently in the shakeout phase. It is trying to humiliate you. It is trying to make you look foolish for holding. It is trying to force you to sell your winning lottery ticket for pennies, because the ride is getting bumpy. Do not let them take your ticket. So, how do you survive the hot zone between here and 106? How do you keep your position when the volatility is designed to kill it? Rule number 1, size down to size up. This sounds counterintuitive, but it is the secret of professional traders. If the volatility doubles, you should cut your position size in half. Why? Because if your position is too big, your emotions take the wheel. You will panic sell at the bottom of a flush because the dollar loss looks too scary. By sizing down, you earn the right to hold through the chaos. You make yourself unshakable. You become the casino, not the gambler. Rule number 2, buy the flush, fade the hype. When silver rips 5% in the morning and the Twitter crowd is screaming to the moon, do not buy. That is the trap. Wait for the margin call cascade. Wait for the moment when everyone says it's over. Wait for the 9:45 a.m. smash. That is when the professionals are stepping in. In a bull market, you buy the red, not the green. Rule number 3, know what you own. If you're holding paper silver, SLV, futures, options, you are renting exposure. You are subject to the rules of the exchange. They can change the margins. They can change the rules. If you are holding physical metal, you own the asset. In a Rule 7 scenario where the market breaks, the paper price might go to zero while the physical price goes to infinity. Make sure a core part of your portfolio is outside the digital system. I want to leave you with this. There is an old saying on Wall Street, the market climbs a wall of worry, but in silver, it's different. Silver climbs a wall of disbelief. We're moving from a world where silver was just an industrial ingredient for iPhones to a world where silver is the only monetary life raft left. When that psychological switch flips, when the world realizes that the safe and government bonds are actually the riskiest assets on the planet, the rush into gold and silver will be like trying to push the entire ocean through a garden hose. The volatility you see today is just the hose shaking under the pressure. Don't blame the hose, just make sure you're holding the water. The mainstream media will tell you to sell. They will tell you it's too risky. They will tell you to go back to sleep. We know better. If you want to navigate this transition with your eyes open, if you want to stand with the few who understand the mechanics of the machine while everyone else is getting ground up by the gears, then you know what to do. Join us, subscribe, and turn on notifications, because the next time the margin call hits, you won't be the one panicking. You'll be the one buying. Stay safe, keep your size right. And I'll see you on the next one.